Hello, everyone. We're going to give a few minutes to let everybody join us. Hey, Marco. You'll notice as you're joining, your microphones are shut off, and we're going to get started in about a minute. And I'm anticipating a lot of people joining us throughout the next 20 minutes because we have about 94 people registered. So please be patient as people start popping on.
Yes, thank you everyone for being here. This is the unofficial thank you for being here today. There'll be an official thank you being here today shortly.
Thanks, Alan.
Thanks, Alan.
Oh, thanks everyone. That's very nice.
So as the waiting room continues to clear out so that I can focus on the introduction, I will start. Because otherwise they'll have to wait. And Eric has a lot of information to share today, so I want to make sure we have enough time.
Yeah, there's never enough time.
No, never. All right, so it looks like we're calming down. People are going to have to wait now. So with that, I want to thank you for your patience. I'm really excited. Welcome everyone to today's NextGen Nexus LA Real Estate Global Perspective and Local Opportunities virtual session. My name is Kathleen Tepley and I'm the founder and CEO of Los Angeles Consulting Group. Today's presentation is titled COVID-19 Investment in Real Estate Markets. And the goal of us hosting these amazing events with Alan Esrock and NextGen Nexus is to bring you impactful topics and highly acclaimed speakers. Before we get started, just a few housekeeping items. First off, if you haven't used Zoom before, in the upper right-hand corner, there's a view tab. And if you want to see Alan and or Eric when they share, you can click on the speaker view. And if you want to see all the attendees, you can click the gallery view. Next, as a benefit of attending today's session, our team, Los Angeles Consulting Group, will send out a thank you email with the PowerPoint presentation, a clip of the video, in case you want to share it, contact information for Eric, and also a link to the NextGen Nexus membership page where we have a lot of information, a huge community, and we'd love for you to join. Also, if you have any questions during the session today, please feel free to put it in the chat function. Eric's going to be monitoring that, and he is open to taking questions throughout today's session. So he's good that way, and I'm really excited to have you share your thoughts and questions. And to open today's session, let me welcome our speakers, Alan Esrock and Eric Sussman. And with that, I want to start with Alan so that he can then share more information about Eric. Alan is the founder of NextGen Nexus, the first local global community of family business and family office NextGens whose lives were shaped by working in or for family enterprises. Alan understands the world because he started working for the big man's shop. I know that shop well because I'm from Minnesota. In his family business, when he started at 5 years old. After college, he joined Macy's department store buyer training program in preparation to return to run the business, and that didn't happen. Alan moved to Los Angeles and pursued his dream of being a television comedy writer. After tasting success, he realized that he hated being a television writer and became a leader in the digital entertainment world as an executive recruiter, a consultant, and an entrepreneur. One of his companies, Jitterfingers, was a safe social networking solution for tween girls and their BFFs with an online club in 200 plus cities in the US and 12 countries. After Jitterfingers, Alan returned to executive recruiting, was asked to speak at a family business event. He recognized that while the world had changed, the unique needs of NextGens remained the same. He started NextGen Nexus to create a community where next gens could meet, learn, grow from each other's experience. And I'm honored to introduce and present Alan Asrock. Alan.
Thank you, Kathleen, for the wonderful intro, but you left out one really important aspect. That 5-year-old job, and pretty much every first job is, and the most important question is, did I get paid? And that's really important. And in fact, for all the webinars, seminars, books, videos, everything that people are now talking about family businesses, any discussion, kind of that one element that brings it all together that everyone gets is if they got paid for their first job in their family business. Next Gen Nexus is about the dichotomy of loving the family business, but hating that family business, and sharing that strange mixture of personal and professional issues with people who actually understand exactly what you're going through, because they're going through the exact same thing. I'm really very excited to introduce Eric Sussman, Managing Director of Clear Capital, because he is here with us tonight. Clear Capital is a real estate investment firm that creates value for investors through direct investment in multifamily real estate assets. He's been a faculty member, and you see his UCLA background, so good planning, at UCLA Anderson School of Management since 1995. He's been voted Teacher of the Year 15 times by Anderson students. He's been awarded the Citibank Teaching Award, the Niedorf Decade Teaching Award, and received the university-wide Distinguished Teaching Award in 2015. So I took a look at his presentation beforehand, and all I have to say with this is fasten your seatbelt. It's going to be a jam-packed ride. Eric Sussman.
Well, grateful. Thank you, Alan. I really appreciate those kind words. So I do have a ton to talk about. I was joking before this session that I somehow have been very, very lucky because I found a career which actually pays me to talk, which is one of my very favorite and maybe my best skills. But anyways, what I want to talk to you all about, of course, is sort of where the real estate markets are, broadly speaking, where they're headed. Obviously, COVID has thrown a wrench into many different aspects of the business, and I look forward to engaging session with you all. So without further ado, let's get rocky and rolling. I always have, this is one of the slides I always use in my PowerPoints, just about predictions. Of course, I often joke that my 3 favorite philosophers are Calvin, which is from Calvin and Hobbes, as opposed to the old theologian, Yogi Berra and Dilbert. Predictions are a tough business, as Yogi Berra said, and so if I prove to be incorrect in anything that I say here, you just forget you even ever heard about me or from me. I always joke, if you ever want to know how hard predictions are, never forget that the Psychic Friends Network went bankrupt. That should tell you everything you want to know about that. So look, I'm going to just put this stuff out because I got so much to talk about and whatnot. So look, whenever I give these talks, especially over the last year, and I've given many of them, you sort of lose sight of the big picture, and that is just how devastating, of course, COVID has been. 500,000 people lost, and I don't want to overlook that reality. But I will say, if we sort of talk about the economic forecasts and predictions, and by the way, I try to be very transparent with all of my teachings and writings, and I know probably many of you subscribe to our quarterly newsletters and all of that. And I've said from the very beginning, this whole idea of a V-shaped recovery, which many on Wall Street and others were proposing was going to happen. They were just inhaling a little too much of California's favorite herb, which, by the way, is not kale, for the record. That's the second most popular herb. I mean, it's nuts, because for anything that it's just any number of reasons, just because the recovery was going to be sort of just fits and starts. I think people said it's a K and so forth. It's just that what we've gone through has been so cathartic and so significant. I just don't see it's going to be sort of kind of V-shaped recovery. But that's my view. As far as, distressed opportunities, that's a question I get asked many times is, is there going to be great opportunity to buy distressed assets? And there may be some, certainly in retail and hospitality, perhaps some office. But frankly, as we'll talk about, it really depends on the lenders. So it really depends very much on the lender's attitude towards forbearance, restructurings, and whatnot. Obviously, with moratoriums and everything else is sort of delaying economic reality. And I think over the next 6 months, we're going to get a lot more clarity on that as sort of moratoriums sort of end, forbearance agreements with lenders sort of end, and we'll have to see. As far as government stimulus, obviously, Washington is still futzing around with what they're planning on doing. The Democrats, of course, have proposed a very ambitious relief bill. The Republicans, I think, are fighting it for purely political reasons, mostly. There are some aspects of it which I think will get tossed. But look, that will soften the blow, but, sending people whatever, $1,200 or whatever the ultimate, $1,400, whatever the ultimate number is going to be a drop in the proverbial bucket. Frankly, it's until we get the job market back to where it was or something more towards normalcy. I think we can, again, put aside this whole V-shaped recovery. The one thing that I have written about, and I think where the market has gotten it wrong quite possibly, is on inflation. If you look at, let's say, where inflation was sort of priced versus swaps or anything of that nature, the market was expecting very low inflation. And we've seen the 10-year Treasury. I'll show you that. It's up to hitting 150 almost this morning. Look, it was trading below 90 basis points, less than 4 months ago. So we've had a huge, actually, relative rise in 10-year Treasury rates. And I think the biggest risk our economy faces, other than, of course, just this sort of fits and start recovery, is inflation. With the Fed largesse and these tremendous stimulus efforts and the amount of liquidity, $16 trillion on the sidelines right now, record highs, I very much am concerned about asset inflation. I do think, actually, look at the equity markets. I mean, look at, shall we say, GameStop, everyone? Okay, maybe we should just end this call. Okay, forget real estate. I want you all to go out right now and buy GameStop and Bitcoin, and we'll call it a day. But in all seriousness, there are aspects of the equity markets which are just completely bloated. I mean, completely disconnected from their fundamentals. And I think in part that is, while yes, it's looking forward, the equity markets look forward, there's no question that the amount of liquidity and coupled with low rates has really distorted valuations. And I'm sure you'll have some comments and feedback from me on that. As far as, just more sort of tidbits, obviously, that is the Democrats obviously are in control of, Congress, practically speaking, and the Democratic administration. I'll give you some slides on what that means, most likely in terms of deficit spending. And you can bank on the Fed balance sheet getting more bloated over the next 24 months. No question about that. I'll show you some data there. Look, as far as the impacts of COVID, the biggest one that's right there is wealth inequality. Now, if you look historically, some academics have said that actually pandemics actually reduce wealth inequality. But I think historically that the data is very muddled. We haven't had very much data on it. So you can get sort of lulled into a false sense of data by just a few data points. Look, that is my biggest concern. I'll talk to you about that. Wealth inequality, the haves, the have-nots, as I call the 3 H's. It's not just the haves and the have-nots. It's the haves, the have-nots, and the homeless. And if you think that is not an issue, you are clueless. I really believe that. History tells us very strongly what can happen when wealth inequality becomes too significant. The social unrest we've seen, we can talk about that, is certainly part of that. So we need to think about that. I'll give you some thoughts there as well. The other big trends, and again, I'm big on sort of broad trends to think about, the 3 A's as I call them: Amazon, automation, and AI. They're here to stay, and they will be disruptive for years to come. And we can talk about that, all these things. As far as real estate goes, and certainly in the housing space, I spent a lot of time. I'll give you some information on public sector. Look, the public sector has failed miserably in this regard in providing affordable housing. It's one of, again, part of the biggest issues that our economy and our country faces. And that is, again, housing basically becoming unaffordable. Again, that's my first slide, as I accidentally showed you. But, the median home price in the United States now is $350,000, up 11% year over year. In California, we're talking $700,000. And if you want it, we'll talk about sort of this, I call it this demographic diaspora, where people moving from the coasts inland it's in direct response to basically housing affordability issues and challenges. And so we have to get our shit together, to put it in very formal academic terms, because otherwise we're going to have real issues socially. As I said, drive anywhere in West Los Angeles or Los Angeles generally, and you can see what I'm talking about. And that is, people look at California as the poster child for homelessness and housing affordability. That's again, to put it in wonkish terms, a load of manure. It is a national problem. It's a global problem, actually. Just again, while I'm talking about it, I talked about it in one of my podcasts recently. Berlin has a 5-year freeze on rents right now. Berlin, 5-year freeze on rents. And housing affordability is an international issue, actually. So again, people pointing at California as somehow being maybe the poster child for it, but it's certainly not alone. All right, here's the data on housing. It's a 90-day lag, as many of you know very well. Case-Shiller data is 90-day lag. So the latest data we have is basically November, although frankly, it doesn't matter because you can take these, the data points as of November and just keep going up to the right. Again, housing has been on an absolute tear. We'll talk about it. It's really, again, the supply-demand imbalance. We have so royally screwed up housing supply for any number of reasons, some of which are controllable and some which are not. But everywhere you look, housing prices are basically, at sort of record highs, surpassing their former highs before the, again, these are all nominal dollars, by the way, not discounted, but basically record highs, and we all know that reality. That's everywhere you look across the country, pretty much. So we'll talk more about that, but we all know that reality, and I'll give you some more data points. As far as commercial properties, same thing. Commercial properties are trickier. In fact, getting data on real estate is always a tricky proposition, because it's funny. One of the most common questions I get asked everywhere I go is, "Hey, Eric, or Professor Sussman, what do you think of the real estate market?" And I say, "Well, what do you mean? Are you talking single-family homes in the Palisades? Or are you talking industrial properties in Houston? Or what market are you talking about?" There is no such thing as a market in real estate. It's just a local game. So Case-Shiller, of course, at academia is for housing, and you can talk about it if you're curious. And then MIT has its own industrial or commercial index. But again, it's, sort of, the data isn't perfect. But again, you just look at that data, it speaks for itself. Real estate has been on an absolute tear. Frankly, if you look at, we'll talk about apartments and industrial have been the darlings of the marketplace because they've benefited not just from lower interest rates and that lower kind of denominator, but increased rents and numerator. As you look at the others, certainly in retail and hospitality, well, less so, hospitality is its own beast, but certainly office and retail really benefited mostly from the denominator, just the yield curve declines and interest rate declines, opposed to tremendous growth in that numerator and rents. So again, apartments, industrial, when we think about commercial properties, need to be carved out from other segments of the market, and we'll talk about that. I'm sure you'll have questions for me. As far as REITs, I always throw this data up here on real estate investment trusts. They've had it tough lately. Again, not surprisingly, perhaps. REITs over long term have done fantastically well. Again, real estate investment trusts, this is from the public markets. There are private REITs as well, but lately been taking it on the chin pretty much, really with the rise in two things. One is the rise in yields, I think, in part, which has hurt, and just COVID-related issues, obviously, in certain segments of the market. All right. Look, the biggest risk, I'm going to throw these up here again. Each one of these could be a topic in of itself. But look, the risks that I see in the real estate market are just asset bubbles, generally. I mean, again, it's one of the things I spend a lot of time talking about and it's one of the reasons I really love about real estate is everything affects real estate. I mean, you point to any economic data point, any demographic data point, they all have some effect, whether directly or indirectly, on real estate asset prices. Look, the biggest risk I see right now is speculation in the equity markets, whether it's the IPO sort of things that make me nervous, where you have, let's say, I mean, look, Airbnb going public or DoorDash going public and seeing 90% rises on their first day of trading. Now, for those of us with a little gray hair, which I know is more than a few of you, and I hope you don't take that personally, I'll throw myself in that particular bucket. That should remind us of a certain history, a time in history, and that's 1999. I haven't seen those kind of moves in 20 years, and we know how that ended, and that's not well. Record levels of fundraising, both in the debt and equity markets. Those of you thinking about SPACs, these blank check companies, again, there will be some, I can guarantee you, some blowups. We'll talk in a few years, there will be some huge, very high profile bankruptcies and distress in some of these special purpose acquisition companies that are going public. And what I would tell you all, and again, I know some of you have been in this business in the markets for a long time, is look, when you start seeing what I would call newfangled sort of investment vehicles, I don't care if it's tracking stocks, I don't care if it's SPACs, I don't care if it's the CMBS market explosions, just above sort of what's customer and expected, watch out below and pay attention. So be careful. Look, the speculation, I'm joking about GameStop. I said it half jokingly. I mean, look, that should make all of us nervous. As I said, whatever the reality is there and what's happening, and again, I did a podcast on GameStop a couple of weeks ago. There's just the speculation, my podcast on Bitcoin will be coming out later today or tomorrow. Again, my natural inclination is just to get nervous, and I quote Warren Buffett fairly often, but be nervous when people are greedy, and fearful when people are greedy. Fearful when people are greedy, and greedy when people are fearful is important. So as far as systemic leverage, the third bullet point here is an important one actually, and why we're not going to have a huge crisis. The bank's balance sheets are in good shape. So thankfully, the banks have gotten their what together and haven't been stupid like they were, as we all saw in the last crisis, where just they were loaning money to corpses. Actually, and loaning money to corpses, by the way, is not a good business model, just for the record. But there is some leverage in the margin debt. Actually, the one area of the market where you do see some leverage and it's concerning is margin debt. And it's at record highs right now, which probably isn't shocking given where the equity markets are, but that is where there is some systemic leverage. The rest of the leverage in the market is actually not intolerable. So that is a good news. That does provide some buffer. Wealth inequality, as I mentioned to me, is in my opinion, the single largest issue that our country faces, if not the world. And it will manifest itself in real estate. There's no question, in housing. And we can talk more about that. As far as the Fed largesse, that does make me very wary about inflation and asset bubbles. In the short run, obviously, deflation may have been more of a concern, just as people sort of, get their economic footing back. But look, I guarantee you, for most of you on this call, and said with no disrespect, most of you are probably the haves, okay? And I'll put myself in that category, and I'm sure all very grateful for that reality. But think about, where your money is. Most of us are just not sure where to place our money right now, and where yields are and everything else. And as I said, cash on the sidelines is at record highs. So, with all this money on the sidelines, all this liquidity, you see the froth, and people sort of thinking about where to put their money. And in real estate, we'll talk about it. Even with COVID-19, asset prices have barely moved. We're in some best and finals on several multifamily assets in the Southwest, in the Sun Belt, and we're going to lose out. I mean, I have to, at some point, we had our partner call this morning. I just said, no, we're not going above that figure. And, I'll let somebody else take on that risk, but there is a tremendous amount of liquidity and people bidding up assets everywhere. So even with COVID-19, again, the amount of money on the sidelines is quite remarkable. Again, on the last point, again, anyone who speaks to you about a V recovery is, as I said, is nuts in my opinion. I don't mind saying it. If nothing else, because as I often half joke, is that inertia is the most powerful force in the universe. I know it's gravity. It probably explains my B- in physics. But, it's just that getting people back to sort of travel and sort of just to behaviors is going to take some time. Yes, those of you who are the haves, God bless, you will be back spending money, and maybe even more than you did, just to sort of make up or to celebrate your inoculation or something like that. But for the rest of our economy, run by mostly the middle class, that's going to take some time. And getting unemployment back, it's below 7% now, but really it is something that's more of a solid economic footing is going to take some time. So don't kid ourselves. As far as Look, this is some longer data. I always like to provide as for the longer view. This is again from Robert Schiller, good old Case Schiller. And just the thing that I sort of find fascinating about this longer view is sort of the home prices and versus population. Look, a lot of academics like me, we run regressions and we do these econometric models and we think about how things move in correlation or causation and all that good stuff. And if, common sense tells you, look, housing prices should have a fairly high correlation with population growth, right? I mean, which generally moves in a, straight line through recessions and growth. Obviously, in good times, we have greater population growth, and in recession and COVID, by the way, I'll show you some data. We have had record low fertility rates right now. It's another big concern. The United States is going to actually shrink in population, quite possibly, if we don't get our immigration policy right. But look at that graph on home prices. So, you look historically, when home prices sort of disconnect from population, you sort of start wondering, okay, what's driving that? Is that speculation? Is that just a lack of supply? And in this case, certainly go back to the financial crisis, you had certainly both, a lot of speculation. And now it's really supply, on the supply problems we have and not providing enough housing, both in multifamily and single family. And there, with interest rates, 30-year mortgages still below 3% and lots of liquidity, there is some speculation there and aggressive buying. We can come back to that if you'd like. Cap rates. So this is cap rates, which of course is the single most important, measure there is in real estate. Unlevered returns. The data speaks for itself. Cap rates remain really low, but I will tell you my biggest single concern is cap rate expansion with growth in yields. So again, do not put your fingers in your ears and not paying attention to what's happened to the 10-year over just the last 3 months. The market is telling us some things, and I think we need to pay attention. So the question is really going to be, what happens if yields continue to rise, and again, so much liquidity on the sidelines come into asset prices and cap rates, how cap rates respond. So you're going to have sort of, I think, headwinds and tailwinds. The tremendous liquidity and competition for assets is going to obviously act as a I would say compress cap rates further, but certainly keep cap rates low. On the other hand, the 10-year marches upwards above 140, 150, and we'll see where it ends up. Obviously, and spreads widen on mortgage products. With leverage, that's going to be a significant headwind on and expand cap rates. So you're going to have this sort of interesting battle, and I'm going to be curious as to how that plays out. It's going to be, again, a good MMA match, frankly, between the tremendous liquidity on the sidelines and the increase in rates as treasuries and spreads expand. All right, so we can again talk about that. Look, everything's correlated, and again, equity market performance has got a very high correlation to real estate values, which probably doesn't shock you, because frankly, equity values are tied very much to consumer confidence and other variables. But look, I mean, I gave a talk, which you can, if you're really bored and want to go back in time, it was on YouTube back in March, when COVID first started and equity markets were down 30%. I mean, remember back in March, equity markets were down 30%, and they bounced back with, just an extraordinary rebound. And look, if I know I'm doing a lot of very educated, intelligent folks. If I had asked you, what you thought the equity markets would do between March or April and December, I don't think any of us would have predicted what happened last year, unless you're not being truthful, right? And I think that's true. Even I didn't. I did state publicly that the markets would bottom out before peak COVID deaths, and I wasn't being, again, not dismissive of that terrible reality, but just that's the way markets are. They look forward, and actually that turned out to be more than true. Equity markets again up marginally this year again, and again, that tremendous liquidity is to blame. So look, this is going to be an important thing to watch, obviously, and as I told you, I'm very concerned about just sort of bubbles in certain pieces of the market, for sure. The low rates, again, I'm sure you're going to want to talk about those. They again speak for themselves. The Fed funds, the 30-year and the 10. As I said, the 10-year has risen substantially. I mean, again, a rise from, let's call it 90.9%, 90 basis points to, where is it? I think it was 148 this morning or something like that before I got on, hitting 150 in just a pretty much the blink of an eye. Is something to pay attention to. It's not shocking, but it's just of concern because that's going to expand 30-year mortgage rates. Obviously, the Fed fund rates is where it is. So we can, again, discuss that in more detail. Here's a more granular look of the yield curve, the Treasury, again, not to, get too basic, but obviously this is the most significant graph there is in all of finance. Frankly, it is the yield curve, obviously, because everything in terms of risk and return is priced off of the yield curve and premiums. And for those of my my former students, again, we spent some time talking about equity risk premiums, and I don't think academics can agree on what that is. But in any event, look, you can see where yields are. It's an upward sloping yield curve, so that's kind of normal. It's just that rates are still by historical standards really, really low. I don't make predictions, and I know a lot of economists make predictions, and the Wall Street Journal runs their annual, forecast. They interview economists, which is, like interviewing my poodle. No disrespect to economists, but look, they're generally, it's a fool's errand to try to make those predictions. I just know that risk is significant, and look, when rates are where they are, again, you don't need me to tell you, the United States is not going to negative interest rates. So just common sense tells you most likely the only place they're going is up, really. The only question is how high. And I do think that all the liquidity on the sidelines will prove to be some buffer on big rises in rates. But, when the Fed does what it does with its printing press, all bets are off. And, I see wealthy individuals and institutions certainly opening up their pocketbooks and continuing their buying. And this is the liquidity data. So look, as I said, there's some, $16 trillion of deposits at U.S. banks earning in fancy language, negative real returns. I don't know what you all are getting on your savings accounts, but I'm going to say it's something between Jack and squat. No disrespect to Jack, so forgive me, but nothing, right? And so even with inflation as modest as it might be, and the Fed's 2% target probably won't come to fruition, but let's say even if it's inflation's at 1.5% and you're earning what, 10 basis points or 25 basis on your savings account, you're earning negative yields. That's the problem, right? People are all this cash on the sidelines, and I know more than a few of you know exactly what I'm talking about because you have that problem. Again, God bless that you do. The question is, what do we do? Where do you put it? Bitcoin? I mean, you're thinking, yeah, you're nodding your heads. No way. I agree. Do not put it in Bitcoin. Okay, listen to the podcast tomorrow. But look. It's tricky, right? I mean, with bonds yielding what they're yielding and cap rates so low and equity markets where they are, we're all sitting here thinking, gee, do we just wait and wait for some downturn and put our money at work? This liquidity is a tremendous buffer. And I think that is, again, going to provide some tailwinds to whatever headwind risks we have, which are not inconsequential. The liquidity is a big buffer. This is just the GDP forecasts and all that. They are pretty uninspiring. That's a word I find myself using all the time these days, is uninspiring. Revisions in GDP. Look, we're going to have a recovery, and I do think 2022 is going to be when we have the bounce. I think this year is going to be just fits and starts, as I said, as it just takes time because they've totally bungled the vaccine rollout. And for those of you have gotten your shots, that's terrific. Congrats. I'm as a teacher, I think I'm next in line. So hopefully I'll be getting mine soon. But look, the reality is that that's just going to cause things to sort of not move linearly on recovery. But assuming we have, pretty much enough people inoculated by the end of the year, so by the fall, I think 2022 is when we really see a strength in recovery. But it's all going to depend on that job market. Again, look, most of us on this call, again, do not drive the economy. Okay, we don't. I have some sobering news for you. As much as we might think we do, we don't. And I've written on trickle down economics. I'm sure some of you will disagree with me. That's okay. You're wrong, but that's okay. Trickle down economics is a farce, in my opinion. It doesn't work. You know, if I hand most of you that have capital money, you go invest it. You don't hire folks. But that's the way I see things. So we're going to have sort of anemic growth globally, and that's sort of not probably controversial. On the jobs front, again, you know, we seem to be making headway, and then we had some sort of mediocre unemployment claims from last week and the week before. Not as bad as it was, obviously, but it just, we've stalled. So the recovery job-wise has stalled. And again, until we have more sustained job growth, and that won't happen, I don't think, until the end of the year into 2022. Again, I just don't see how we can have any real meaningful recovery, which, by the way, is going to be very important. We talk about rental growth, at least in my area of multifamily. You know, we're going to have flat to non-growth in rents, certainly if you take concessions into account in some markets, for probably the next year to 18 months, in my opinion. All right. Unemployment figures, again, you know, speak for themselves. We're at 6-7%, but, you know, I think many of us have been around long enough to have our doubts and our cynicism about the BLS data, because of course, if you're not looking for a job, they don't count you. So the real unemployment rate is, you know, probably closer to 9%, 8%. It's hard to say with precision, but, you know, look, we'll see. You know, it's funny how economists think about the job market, and you know, it used to be when the full employment was 4% unemployment rate. And then in the financial crisis, they said, oh, it's 6%. And then look, we hit, to I think everyone's surprised, we hit unemployment rate of what, at a low of what, 3.6 or 3.5% actually before COVID. And, you know, so actually we went back below that 4% rate. You know, I think post-COVID, it's going to be trickier. I think a lot of organizations have realized they can get away with less and have spent money on automation. And so I think it's going to be, to get back to, I think 5% is sort of a target unemployment rate, again, probably by the end of 2022. All right, again, let's get into some asset types. I'm not sure these are any particular order. I guess arguably these are in order of risk as I see them. And so look, hotels and hospitality generally, but you know, it's funny, I do include sort of VRBO and Airbnb in this sort of hospitality segment because they're doing great. So Airbnb and VRBO, for those of you who have vacation rentals, had a horrible couple of weird sort of moves in 2020. Obviously when COVID hit, everyone canceled everything, just went into the crapper. And then just incredible recovery into the fall because students and workers working remotely. I have some VRBO units, and we have a lot of people paying huge rents, you know, for month-long stays. And I had a bunch of Stanford MBAs, my alma mater, stay in one of my units, like 4 students staying in my units for a whole semester. But no, good. Hey, you know, good students. These are Stanford MBAs, so that's okay. But they were paying big rents and studying remotely. So that's been a big hit. As far as hotels, look, that's going to be a longer slog. And those hotels that have conferences that are really part of their core business, I mean, I can't imagine what the JW Marriott out in the desert is doing. I mean, they must just be getting killed. Obviously Vegas as well, and those that rely on conferences. Retail and restaurants, you don't need me to tell you, just been devastating, obviously. And that will come back, at least the restaurants will, but it's going to be years for that, years. And retail, look, you know, look, what the pandemic basically did, frankly, is just accelerate trends that were already happening. I mean, let's not kid ourselves. You know, shifts away from brick and mortar, you know, and everything else were already happening. It's just the pandemic's accelerated some of those things. Office, obviously, is going to be, I think, the most interesting thing to watch, actually, because office was doing fairly well, by and large, before COVID. And then, of course, we've seen what's happened. And I think that is going to be interesting, what happens over the next couple of years. And we sort of, I think we're going to have a hybrid. Just don't believe these people say, oh, we're going to all work, you know, remotely. I find I'm going to call bull crap on that. Look, we're social creatures. And as I tell my students, recruiters are not hiring the best and brightest MBAs so that you can work remotely. Look, I'm sure in your organizations and certainly at Clear Capital, I love being able to walk out my office and, you know, ask people questions and collaborate on some issues that I'm kind of thinking about and get some feedback. You know, this remote method of working is just not, I think, equilibrium. Now, that isn't to say we don't have a hybrid. You know, there's no question our staff, we have about 20 employees, are going to be probably, you know, maybe doing a hybrid. So maybe they'll come in 3-4 days a week and one day work remotely, or their hours might be a little more flexible, something like that. That's the more likely outcome. And you know, that will, no question, have a negative effect on office. There's no question. San Francisco, you guys, by the way, if any of you need a sublease, there is office space aplenty in every urban core, pretty much, certainly those that are tech related. And that will be a longer slog recovery. But like I said, don't kid yourselves. We were going to be back in the office soon, because frankly, I think we all miss it. As much as I love my home office, I mean, you know, and my poodle, and my wife, you know, we say in Yiddish, "Genuft is genuft." Enough. I'm ready for the office to get back at it. Industrial is, you know, I think a great place to be. Now, for most of us, finding that industrials, we sort of think about the risk tied to industrial. Industrial is going to have some serious tailwinds. Obviously, look, we're gonna have some onshoring of our supply chains. You may have seen a story today, obviously not shocking, with the computer chips and the problems it's creating. You know, again, this trade war with China and you know, involving Taiwan, as well as chips, or of course, the healthcare supplies. So that is going to create a definite tailwind for industrial, no question about that. Obviously, last mile distribution and all the e-commerce. Cannabis, we'll talk again, don't kid yourself. There's a lot of, you know, impacts that are really creating a lot of tailwinds for industrial. For most of us, for those of you who have industrial portfolios, again, that's terrific and God bless. The risk is obviously for most individual investors it's too much tenant risk, right? Too much risk in a single tenant. So it's, you got to be maybe an industrial REIT or have a large enough portfolio. But I think industrial is going to continue to be a very strong segment of the marketplace. And there's going to be, I think, some federal government stimulus to sort of move production of certain key supply chain elements back to the States. So keep your eyes peeled for that, I think, for sure. On housing, multifamily and single family, look, I live and breathe the multifamily markets every single day. So happy to talk to you more about that. Again, we got lots of headwinds and lots of tailwinds. So on the tailwind side is the problems in single family, the lack of supply, the lack of affordability. You know, somebody actually, and I love having interesting dialogues with everyone, and people sort of just spitballing ideas and thoughts. And someone emailed me yesterday and said, "Hey, Eric, Sussman, you know, this minimum wage increase, I think it's going to really create inflation in the housing prices." And I said, "Well, what are you talking about?" I said, "If you think that raising the minimum wage to $15 is going to move the needle on single family home prices, I think you're crazy." I mean, look, at a median home price around the country of $350,000, which of course to us in California and those of us in markets that are, you know, higher price, you're like, what are you talking about? But look, I mean, if you get conventional financing, that's a $70,000 down payment. I mean, you know, now maybe you say, I'm going to get some other more aggressive form of financing, but you think the $15 an hour, again, said with no disrespect, just being candid, that is going to move the needle on affordability of single family, you're nuts. Now, the biggest problem with single family is lack of building, lack of buildable lots, ridiculous. And I think just the, you know, my last podcast was mostly focused on, you know, the approval process and how, and those of you who are in the development side of things, I don't need to preach to you, you know it. I mean, it's incompetent. We need to get control of our approval process. We're building too little housing across the board, and that's a problem. The other thing I'll talk to you about too is just, you know, the baby boomers, which some of you I know, said with no disrespect, are a member of. So anyone sort of post World War II to, what is it, 19, I think, what I define you as sort of 65-ish, 60, right before I entered this universe. The baby boomers have something like $10 trillion of equity in their homes, and they ain't moving. All right, they're not moving. They, for a number of reasons. One is, of course, during a pandemic, of course, but also, look, technology, better healthcare lets people stay in their homes longer. And remember, they changed the tax rules. So this is where, again, I think they need to change the tax rules. I mean, some of you, maybe those who are younger, my parents have lived in their same home in Studio City for 60 years. They're not going anywhere unless they have to. I hope not. But if they sold their home, there's Uncle Sam in the state of California waiting to tax them and collect their pay. And I know my father, who's 89, is like, screw that. I'm not going to do that. So that is a problem in terms of supply of homes. People are just not moving. So lack of building and so forth. That's true on the multifamily side as well. I can get all wonkish with you all on things like lumber prices and commodity prices. As you follow, lumber prices are at basically all-time highs right now. We've had huge just volatility in the price of various goods. Labor is an issue. Most developers will tell you they're having problems with labor. And I think that was something I hope this administration kind of squares. Whatever you think about immigration, we do need the right immigration. I won't argue with that, but we need more labor. Again, you can't get subs, you can't staff your construction problem, you have a problem. Happy to talk about other niches, but in the interest of time, I'll move off of that. Obviously, student housing and senior housing have gotten really hit hard from COVID, obviously, for sure. Look, this is I'm sure Alan saw this slide and almost said, "Oh my God, Eric, what are you doing?" Because again, this is an eye chart. But like I told you, what I love about this crazy business, and for those of you who had the misfortune of having me as a teacher, these are all really interesting topics. Everything affects real estate. Everything does. And I have a bad habit of walking the class and, something will be in the news, whatever it is, the price of oil hitting $50 or, the US dollar taking a hit or something like that. And I'll say, how does that affect commercial real estate prices? And of course, I'll get these blank stares and I'll say, look, everything affects real estate prices. So I'm not sure which ones to spend time on here. I'll just maybe pick a few that are interesting. COVID rates, we've talked about equity markets, most of that. I think the sixth one, if that's the demographics, I think let me just talk to you about that. I have some data coming up. That is super important. Maybe one of the most important data points we can talk about. And that's everything from when people are getting married, right? Which we know is later and later. The number of children that couples are having. So the United States is now at 2.1 children per couple, which is a record low, which basically means our population will not grow. In fact, we are probably right now, in my opinion, the United States at a population of 330 million people is probably within 10% of its peak. All right, so if you stop and think about that, without immigration, okay, we'll see about that, but without immigration, we are near the peak. So if you're thinking about demographics and demand for everything from housing and everything else, if the population is sort of static and doesn't grow much over the next 5-10 years, then what are you talking about? You're not talking about more people. You're talking about sort of, again, I call it the sort of diaspora, exodus from the coast or where people are going. And then you're trying to think about which markets, which secondary markets, which tertiary markets, maybe which quaternary markets you really ought to be focusing on. And again, we can talk about that. And again, my last podcast, I talked about the Wall Street Journal had an article last week ago, Friday, the Californians are coming, and it was focused on Boise, Idaho and other markets, but it's true. Boise, Idaho, housing prices up 20% last year, 20% in Boise. And that's could be an issue for us to think about. Children living with parents. I had 2 of them back home. We're supposed to be empty nesters. Okay. Just for the record, this is not how it's supposed to be. I mean, I was supposed to have a really passionate retirement, a lot of love making going on. Okay. After 31 years, I know that's out the window, but at any rate, what I would say is that there are a record number of young adults, that is 21-year-olds to 35-year-olds now living with their parents. And I'm sure many of you, whichever demographic you find yourself in, no disrespect, are doing just that. Now, if you look around the world, that's kind of normal. I mean, around the globe, that is sort of a normal sort of demographic reality. You have multiple generations living under one roof. In the United States, that has not been the way our housing has sort of been formed. That is going to change, in my opinion, as well. So if you look out 10, 20, 30 years, you're going to have in-laws, you're going to have your parents, you're going to have children living under one roof, which is going to make the United States more comparable to other developed markets around the world. But think about that in terms of housing and what that might mean for us. Traffic, student debt, obviously, we'll see again what the Biden administration does wherever you fall on the political spectrum. Again, I try to be fairly politically agnostic in these talks. I can offend all of you pretty easily with a couple of comments. I don't want to do that, but look, whatever they come up with or devise in terms of student debt, I'll leave to the politicians, God knows. But look, that is an issue. The amount of student debt is an issue, if nothing else, because of housing. So it's also a huge headwind in terms of single family home prices. UCLA Anderson tuition, I know I've got more than a few of you who graduated from the school, has gone from $9,000 when I started, $9,000 to what, $55,000 now. And, so many of you who were MBAs in recent years, or undergrads who went to good private schools, are leaving with 6 figures of debt. That's going to be a significant headwind on buying a home. All right. By the way, just another data point you might find interesting. One quarter of first-time home buyers get family assistance. So across the entire country, the FHA has said that 25% of first-time home buyers are relying on parental help. So for those of you parents out there, you know exactly what I'm talking about, and you know it's true. Which again, is that sustainable? Is that really the sign of a healthy housing market? I would say not. Happy to talk about any of these others. The biggest one, others, fourth from the bottom, is land use and regulations. It's my belief, as unpopular as it might be with our politicians, that the state governments need to take control of local zoning. I know that comes with some issues, don't misunderstand me, but if we leave it to local politicians to approve projects and NIMBYism and banana, build absolutely nothing near anyone, near anything, we're screwed. We are really screwed. Housing projects take too long to get approved, even when they're in complete compliance with zoning. I'm sorry. If a project complies completely with local zoning, it should be approved summarily, and there should be no court challenges allowed. Or the judge, and they don't do this, should be allowed to award monetary sanctions against I believe, against people filing legal challenges against projects that are completely compliant with zoning. It's just in California, you can tie a developer up in the courts for a long period of time, and I can bore you with lots of examples of that. It's an issue. Anyways, I keep going, but I'll stop. On the commercial side, very similar sorts of factors that are driving prices. So that same list I just gave you, bricks to clicks, obviously well and good. Legalization of cannabis now, which is, I would say by the end of 2022, will be legal almost in every single state. Those of you who are in the industrial markets, I'm sure have had more than a few requests by prospective tenants to do indoor grows. And I make no, look, I think cannabis should have been legalized decades ago. It's just, our drug laws are probably as anachronistic as some of our zoning ordinances. But look, that is my opinion. It is what it is. It's going to happen. It is happening. So that is also create a lot of demand. And actually what's interesting about that is it's created a lot of demand for what would have been traditionally been less desirable space. So in industrial, of course, it's all about the ceiling heights and loading and, other, you're getting up to 40-foot clears now and multi-story, perhaps in some markets now, really sort of pushing the envelope on industrial. But it's interesting for indoor grows, they want lower ceiling heights because you have ventilation and lighting. And so actually some of the older product we're finding in places like, let's say in Los Angeles, Commerce, Bell, Vernon, and so forth, have been taken up by cannabis indoor grows. Office, this whole creative and open office environment, which was a huge thing. I used to love going to these office spaces where I'd see. I thought I'd walked into the kennel or the pet adoption service. Anyways, we'll see what happens post COVID. So we'll see telecommuting is here to stay in greater numbers, but I think all of us are pretty much zoomed out. Alan just yawned a few minutes ago. Alan, I noticed that, by the way. You're getting a B in my class now. I just lowered your grade for the record. It's okay, no worries. Import-export policy, exchange rates, GDP, again, other things I mentioned that are can be affected. I do think another thing I should have had on here is federal government's requirement of supply chain, sort of maybe regulating more supply chain issues. That will also have a big effect for sure. This is another, oh my gosh, but I always want to give you more. You'll have my slides and you can just have them. Again, I could talk about all of these at length for sure. So maybe just take an eye, sort of scroll down the list here. You can take a listen, ask me any questions that you want. Maybe a couple that I've written about that I think are worth talking about for those of you who are interested is this fourth bullet point. Look, and this is where public policy has got it all wrong, just screwed it up. And look, politicians, because of their nature, don't want to look like they're not doing anything to deal with housing issues and so forth. So what do is they expand rent control. They create inclusionary zoning ordinances, which basically require developers to set aside a certain number of units as affordable as part of any project. 20% is sort of a baseline in most communities now, which I kind of get, right? On the surface, it kind of makes some sense. We're going to, try to get a hold of affordable housing by, creating these sort of price controls or sort of these regulatory restrictions. But here's the thing. They just don't work. Look, economists may not agree on a lot, and there's some good room for good debate on a lot of issues, but almost all economists universally agree that rent control and inclusionary zoning don't work to stabilize rents. They don't make housing more affordable. They just don't. And again, we can talk more about it if you have questions. What I think needs to happen is economic carrots, should I say. So the ones they use are economic sticks. Economic carrots. If you say to a developer, look, or us, say, look, Eric, we want you to take Section 8 vouchers, and now in California, you have to take Section 8 vouchers, but you're going to market rents. You're going to get your market rents. And so you're not going to lose economically on the rent. You're going to have, by and large, that's a carrot. If you said, Eric, look, you take rents from a tenant who's at 50% of the average median income in your zip code, we're only going to tax you at half of that income, or we're going to give you a more favorable tax rate or something like that. We can all talk about ideas. You'll incentivize in the right way. We need more incentives as opposed to sticks. All right. And rent control and inclusionary zoning are sticks. So I'm big on I have a lot of ideas for politicians. Again, on my most recent podcast, I don't think anyone's going to have me in politics anytime soon, but I wish politicians had the will to get this stuff passed. The problem is, as Bernard Parks once told me in a meeting, Eric, look, there are just a lot more tenants who vote than landlords who vote. Sorry. And I never forgot that quote. As much as I hated frickin' hearing it, it was such a great quote. And I really had a lot of respect for Councilman Parks. He really told it like it was. And he's right. So that's what politicians do. They go for the easy political wins instead of the much more challenging political realities. And that is, one more example, by the way, for those of you who really want to know California. So you may have heard of SB 50, which was an assembly bill that's been tried to be passed twice now, which would have put more control for approvals, zoning approvals in the state government and take it away from local politicians. And it's failed twice, even though there's no question it would help our housing problem. Okay. But, it's a local political game and I get it. Their constituents, don't want it. Anyways, what else can I talk to you about? Homelessness, we talked about clean energy, climate change, NIMBYism, the Tax Act. I'm happy to talk to you about, again, Prop 13, which of course failed. I'm sure there's gonna be more efforts. We do need property tax reform in California. I was against the bill, not because I was against reform, just because that was too expansive and, and problematic. But again, happy to take some questions. And again, I hope you appreciate, these are all, I think, really interesting topics. And good for debate and, for honest, vigorous debate from both sides of the aisle. But we don't have that. That just ain't happening right now, as you all know. This is a picture it's from 2019. I can update it on just which states have done sort of more of these economic sticks over the last years. It's going to keep going and going again. Look, I think these moratoriums are unconstitutional. Look, I believe in compassionate capitalism. I do. I really am. I try to practice what I preach. I don't believe in socialism, and I don't believe in libertarianism. I'm a moderate. I should say that in transparency. I call it compassionate capitalism. We should help those who need help. I have no issue with that. But what the governments do, as you can see, and even the moratoriums, how you can tell a landlord who's got an enforceable contract, you can't do this, you can't do that. It's an economic taking. I don't know how that passes the 14th Amendment, but look, that's why I'm not a lawyer. Some of you are. I'm a lawyer without a license. But you can bet sure as heck that these are going to expand. Politicians are going to go for the easy wins and expand efforts to keep tenants in their units, to moderate rents, and all it's going to do is exacerbate the problem ultimately. So we'll see how that goes. I'll give you a bunch of slides from various sources. Forgive me real quickly. And a lot of you live this and breathe this. So this is some rent. And again, you'll have all these slides. So I will make sure you have copies if you'd like. Some high level on occupancies. And again, this is where you have to be careful on multifamily, distinguishing between physical occupancy, which still are really high at 94, 95% nationally, and economic occupancy. Many of you, I'm sure, are facing issues with collections and that sort of thing, depending on which markets and assets. So unfortunately, we don't have as good data. We do have some data on collections, but it's not outstanding because it's sort of self-reporting. But what's happening is landlords are collecting maybe in total above 90% now nationally. Very much depends on the markets, but they're coming in much later. I'm sure many of you know what I'm talking about. The rents are coming in on the 25th of the month. You can't evict people anyway, so you're working with them because it perhaps the compassionate and right thing to do, despite moral hazard and some people taking advantage. That's for damn sure. But keep at that. As far as more granular data, it is a tale of many markets. Look, the big markets that have high exposure to techs: New York, San Francisco, Seattle, down big double digits. New York rents, including concessions, are down, I would say 30% probably. I mean, it's hard to know because some landlords are giving away the store with concessions. And so again, it's hard to measure. But then you look at like the Boise's or the IE here, or other sort of secondary and tertiary markets, which are seeing rental growth. So again, this is where I cringe when people ask me about the market, because there's no such thing, and we have to be more granular than that. Again, some more data on various markets on occupancy. You can see, Ann Arbor, Michigan. Well, Ann Arbor, Michigan. Probably none of us here have units there. Good old Big Blue. Anyways, collections, here's the collections data. Again, you can kind of see where collection is, and this is, I think, through the end of the year. But what's happening is rents are coming in much, much later, as you can see. So we're getting, by the 6th, it's 80-ish%-ish, whatever. In December, actually, we're in the 70s. So people are paying, but it's like waiting for Godot. And this is a hugely important slide. The supply problem I talked to you about is just, we need more housing. And that is going to that's going to require political will. It's going to require more effective immigration policy and a lot of stuff which our politicians are just, some French is coming into mind right now, but you can appreciate where I'm coming from. And the data speaks for itself. We're just, California needs, I don't know, call it 350,000 rental units a year just to meet up with demand. We built 250 for the last 10 years. So we've just had this perpetual shortfall, and that's true in single family as well. Construction pipeline, not surprisingly, for 22 is down, and it's going to be down in 23 and 24 for all the reasons I mentioned earlier, from just supply of buildable lots to zoning crap to lumber prices to labor shortages and the rest of it. All right. Just going as I always do, I want to give you more information than less. This is just some realities, but our likely realities of, again, not being political, just being sort of candid about it, with the Democrats sort of in charge. And it'll be tricky because not every Democrat is going to vote yes on everything, so they'll have to negotiate within their own party. But there's going to be deficit spending and big changes. We'll see what happens with taxes and everything else. But I thought this was a really good slide. This is one of my favorites that I've seen, actually. sort of in one picture, sort of telling you where the spending is going to likely be. So I thought this was a good slide for us sort of to capture everything in one look. And if you look at the left, it's taxes. They're coming for us. So most of you on this call are going to be paying higher taxes, and I'll leave that for another day. Deficit spending, look, debt to GDP in the United States is not worrisome yet, but as you get, higher, we're, above 110, 125%, and it keeps going, we're gonna have to watch that. And I do have some concerns about that. I mean, Japan, of course, with tremendous debt to GDP, of course, has had, no growth at all and no inflation. So it's not always clear, but it's just something we need to watch for sure. This is actually, again, something I've talked about already in passing, but not, again, as Wayne Gretzky said so well, it's never where the puck has been, but where it's going. And so, I spent a lot of my time, and many of you probably spend time thinking about where people are going. They are leaving the coast. Obviously, California has had net out migration every single year for the last decade. It's exacerbated by COVID. That trend is not going to change. New York is really same thing, lost residents. So where are they going? The Southwest, the Sun Belt. I mean, it's booming. I mean, as I said, we're competing on prices for assets everywhere from Phoenix to Atlanta. And I just sort of, I'm like, what are these buyers projecting? I mean, I know that there's an old joke is how can you make any real estate or M&A transaction work given MBA, Microsoft, Excel? It's like David Copperfield magic. But, you want to assume rental growth, just change that cell. That's great. But I think, I'm a little bit worried. But look, anywhere from Boise down to Vegas to Phoenix, obviously Dallas markets have had tremendous growth, into Nashville, Atlanta, Raleigh, Durham, Charlotte, obviously are going to be growth markets. But of course, price is what you pay, value is what you get, and we'll have to see how that all shapes up. For sure, and happy to talk to you about it if you have any time. These are just some top markets by net migration for you. I just mentioned a lot of them, so But again, many of you know this intuitively. So these are markets where you'll be looking, and I'm probably telling you where we're looking, but it may be markets outside these markets. So that's maybe a place to focus on, not maybe within these markets, but then looking outside those markets and where the next place people are headed. I told you this already on fertility rates and young people moving back to the nest. That is an issue, and it's going to have very significant impacts. So you may find some of this data interesting for your analysis and thinking as I rock and roll here. And I think it's actually good. So I got plenty of time for questions, which I always want to do. See, Alan, you thought I wouldn't get through? I talk a million miles an hour, and I just didn't take questions. I want to get through everything. I love, this was actually in an academic journal, an urban planning article many moons ago, and I thought it was great. I'm big on graphs that tell us a lot in one fell swoop. Just maybe some last words, and I'll take questions, and if not, I'll talk about other things. The United States screwed it up. We effed it up, frankly, when it comes to housing. And part of it was just the United States is a young country. We're a young nation. And what happened is, if you look at the demographic shifts post-World War II, west of the Mississippi, it was wide open land, right? We had the highway system, cars became popular in the 50s, the growth of the middle class and the rest of it. So we just sprawled, right? We just built sprawl. The urban cores became sort of decimated in terms of, we call it white flight, and it's sort of not inaccurate, but when I grew up in Los Angeles, nobody lived downtown. And those of you who are my peers in that regard know exactly what I'm talking about. We just built the suburbs. It was the American dream, right? The three bedroom home with the big garage and the rest of it. And we just didn't do good urban planning. I mean, Los Angeles urban planners just screwed it up. I mean, the population in LA in 1930 was just over 2 million. In 1950 was 4. It's 12.5 million. And what do you do now? You guys tell me. You tell me, what do we do now? Right? We got 12.5 million people. We don't have enough housing. Everything's built out. You can't just bulldoze stuff. Certainly, well, if you got eminent domain rights and zoning that was, impactful, maybe, but you can't. And so this graph actually is really interesting. We're a low density country. We have very low density compared to everyone in the world. And so the only solutions, as I see when it comes to housing, more supply, more density, and multiple generations living under one roof, which is part of the density. And that's our future in housing, the way I see it. It's just sort of the economic reality. And frankly, it's going to happen anyways, because your kids, your nieces and nephews and so forth are just not going to be able to afford single family homes unless they get help. I mean, just the way it is. So with that, I got one other, I think this is my last one, just if you want to see a devastating slide, New York retail. I could have shown you for any particular submarket in most of New York City. This is Midtown. And this is the thing that's sort of amazing to me. And again, not to get wonkish, maybe my last wonkish comment is this whole idea of elasticity. For those of you who remember your econ classes, right? Elasticity of demand, as you change pricing of something, how does the demand for it change? In housing, it's kind of interesting. You have elasticity, right? You cut the rents of your buildings. For those of you who own your units free and clear, I would say that's, may not be financially optimal, but God bless if you do. And you can lower your rent substantially. You can have 100% occupancy, no problem. Just lower your rents below the market, and like the cornfield baseball field and Field of Dreams, they'll come. In commercial, it doesn't work that way. In brick and mortar retail in Midtown Manhattan, you can give the stuff away. Hell, no rent. I'll charge you no rent whatsoever for the next year, and you won't get people making offers, because even with no rent, they don't have, the business doesn't pencil. So, I mean, this is the one thing that's fascinating to me about sort of the retail market. Office. As I said, you need a sublease. Those of you looking for space in core markets, especially those that have a lot of tech exposure, you can you have your pickings from anywhere from law firms to banks to other firms that have space for sublease. So all the tech firms. This slide just is crazy. Anyway, so just a few thoughts, and then I'll take any questions that you have, and we can have some more discussions if you like or not. But one thing I tell people to sort of be aware of, and forgive me for those of you who had the either pleasure or displeasure having to hear me talk before, but I always say we get sucked into the present. We all do. There's a great term out of a professor at the University of Houston called chronocentrism, which sounds wonkish. They always use a $4 word instead of a $1 word in academia. But it just is sort of this view that we focus too much on the present and we extrapolate that into the future. And that's just wrong, right? We have crises. And I use an example in one of my talks that if you were, let's say born in 1910, and you were lucky enough to live 100 years, again, very long life, think about what you went through. Think about the crises you had to endure, right? And those of you who are older than I am, and where I am, basically how old I am, you've lived through a lot. Those that lived through world wars and pandemics and crises and the Great Depression and the rest of it, it's a matter of time. If you live long enough, you're going to have some of these things. So the key is, people say, this COVID's going to forever change the way we do things. That's bullshit. That's just wrong. That is not accurate. Now, the question that is, I think, for debate is how long is it going to take before we kind of get back to normal, right? And this is one thing to keep in mind, just to a litmus test for you. Most of you I know, again, are part of the haves. Not all, but mostly, have assets. And I think that's wonderful. Stop and think for a second, really. How long did it take after the Great Recession, the financial crisis of 08 to 010, let's call it, before you invested and didn't give 1 second's thought about it? Was it 2012? Was it, I don't know, probably for most of us by 2012, as crazy as that crisis was, I mean, stop and think how that wasn't, for most of us, the single greatest financial crisis most of us will ever experience. And it was out of your memory banks in terms of decisions that you made to invest within 24 months. Welcome to human nature. It's an amazing thing how resilient we are. It's also why we have bubbles and crises, because we just don't remember crap. My son, my oldest, is 25. If I mentioned the financial crisis to him, I asked him, I said, what do you remember? He goes, Dad, you were really stressed out. Okay. That's what he remembers, the stress I was under. Thanks, Ethan. Yeah, I was. He has no memory of it. And so he's buying Bitcoin. Okay. And not with my money, but because he's not thinking about bubbles. All right. anyways, the other points speak for themselves. I've mentioned already. And I always include that last bullet point in every talk I give is, we should all be very thankful and never lose perspective. So with that, look, I think that is my last slide. It is indeed, although I always have more slides, but let me, open it up for questions. I don't know how to do that here. I've got the,
I got it. Do you want people to talk, Eric?
Yeah, I don't, I'm terrible at, here I see.
Raise your hand if you have a question for Eric, and I'll.
Anyone want to ask, want to feedback, you want to talk about, you want to.
Questions only.
Tell me I got it wrong and I'm full of crap.
Well, Kathleen, we've got a few of them in the chat box if we want to circle back and, and
yeah,
some of those.
sure. I'm happy to do that. Oh God, okay, let me see how do I do that without.
So just hit the chat function below.
Yeah, I know, but it doesn't show in my screen in view mode. So
if you want to shut off your presentation, it might be easier.
Yeah, let me do that. There you go. I'll do that. And there's the chat box. All
right.
And
I put a few in your private too that came in by email.
Oh, private. Am I single? Thank you. Okay, I'm just kidding. No one asked me that. All right. Let's see. Does the rent freeze mean tenants don't pay rent for 5 years? Right. So that's in Berlin. You already went for the Berlin. That's right. There are no rent increases in Berlin. It got passed in the fall. And so for the next 5 years, no rent increases in Berlin. So you talk about rent control on steroids, and this is why people sort of lose perspective. It's a global problem everywhere. The Economist had some good data on this. So you can see it. Yeah, no rent increase for 5 years. Higher rates. Okay.
Anybody else want to put their previous?
Yeah, let's talk about that, because the way I like to think about things, and again, maybe it's my, my being an economist sort of by nature too, is, you always look at things from both perspectives, is everything's, sort of headwinds and tailwinds, right? So I agree with that's a very astute comment, is something an inflation hedge, but you've got to be really careful, right? Because inflation hedges depend on what the underlying asset is, right? So take some of you may have, single net tenants with long-term flat leases, everything from, Walgreens big boxes, or, other properties that are sort of bond-like in their structure, right? No rent increases. Well, those are not going to be inflation hedges, right? Because by definition, you're not able to increase the cash flows from that asset with the rise in rates. You've got a flat lease. Now, in, let's say, multifamily, where let's say you're rolling your tenants, routinely, and it's not rent controlled, which again, that changes the dynamic. The question is going to be, right, are you able, if the inflation is driven by economic growth and improvement in the job market, real wages are growing, maybe minimum wage does get increased to $15. I agree. There, in those markets in multifamily, it's what I've always liked about multifamily, at least in theory, you'll be able to have a hedge against inflation, as long as that inflation is driven for the reasons I stated. So I think it really does depend, but I would look at that as sort of very much asset and market specific. And again, we can have some discussion about that. Now, yeah, that's a great point, Ankur. You're absolutely right about what the Fed does. Look, you're right. Jerome Powell has made it very clear that they're going to keep low rates. In fact, that was what drove the market rally. Was it yesterday, the day before? I was teaching, so I kind of wasn't keeping track when he spoke. But he basically said, look, even with the rise in the 10-year, we're not raising rates, and we're going to keep rates low through 2023. And that's all well and good. So, but just remember what the Fed controls. I mean, the Fed can control a lot. Don't misunderstand me. The Fed has a printing press that with some incredible toner that I wish I had. That is a special HP toner. So you're absolutely right. But, look, inflation comes from all different sources. The markets are far more, robust and advanced than just what the Fed can control. So the question really becomes, what rates can the Fed control? What do they have? And look, there's so much liquidity out there. I know a lot of you have liquidity, and I guarantee you a lot of you are thinking, I'm just waiting maybe until COVID, or I get more certainty on that we're got a sustainable sort of recovery. And I'm telling you, by the end of 2022, that's when I'm worried, when that money comes in. And the Fed can't stop that. I mean, what can the Fed, that's the concern, is the Fed can't control that sort of behavior. So we'll have to watch that. I think that's going to be really interesting to keep an eye on for sure. You know, if everyone goes industrial, cap rate's going down to 3% given its popularity. Look, no, I think, look, cap rates nationally are anywhere from, 3 to 7%, depending on what asset type and what market. Just think of those headwinds and those tailwinds. I think you're going to have some, cap rates aren't going to expand a lot in the shorter run or intermediate term, but I don't think they're going down either. I just don't see that. I just don't. I mean, period. OZs, Alan, you asked about OZs and opportunity zones. That's an interesting one. And it's going to be interesting in the context of 1031 transactions too. Again, there's so many things to talk about. With Biden's potential tax bill and whenever that comes down the pike, our 1031 is going to go the way of the dodo bird. That's quite possible. I mean, most of us have benefited greatly from 1031s while scratching our heads as how can we get away with this? How has this been so great for so long? I would just say this, look, never, 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 never let the tax tail wag the dog, so the investment dog. So, whether it's an OZ opportunity or it's something else, I would step back, Alan, and make sure that the investment sort of makes sense to you, ignoring the opportunity zone sort of framework. And then look, if it does, and you say, I like this project, even in the absence of the opportunity zone tax benefits, then go for it and jump in. But just make sure you don't sort of let the OZ tail wag that investment decision. I think a lot of investors make incredibly ill-suited investment decisions because they just despise paying taxes. History is full of examples of that. Meanwhile, I'm in Maui. Okay, first of all, anyone who says the word Maui in the chat box, up yours, because I'm not in Maui and I'm really upset about that. Anyways, yeah, I don't know. Some of the questions I don't know. You're asking me really specific markets. I don't know, and you're responding to each other, so I don't know. You can't give away office space, right? I mean, so I agree with that. It's what I told you guys. I mentioned the elasticity of demand in commercial doesn't work many times because you can give the stuff away and no one comes. If there's not a viable business model, take the space, which again, in housing is not true. So that's very different about that. I love it. Okay. I love, you want to buy a home in states. I love these specific questions you all ask me. I want to buy a house here for this price in this market. What do I do? All right. Send money to Venmo, eric.sussman@anderson.ucla.edu. And I'll tell you, yeah, where should you put your money? Honestly, it would be irresponsible of anyone in my shoes to answer a question of where you should put your money. That's where a lot of people ask me that, and I sit down and I say, okay, well, show me everything. Show me all your cards, how old you are, your relationship status, your balance sheet, your blah 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 blah, and then we can have an intelligent discussion. You can't even answer that question, I think, on something like this, and I would be careful there. And 1 minute, I've got 7 minutes. So, and I talk too damn fast. So I always want to cover everything, give you more for your money and keep you engaged in this Zoom world, I guess.
Maybe one or two more questions, Eric.
Anyone have any questions at all? Fire away.
Any more?
Anything at all?
We're getting close to the hour.
Hey, Eric, what do you think of like housing that's supported by like Chicago Housing Authority or Section 8 and that kind of multifamily?
Yeah, Marky, I talked about Section 8 a bit. Section 8, and I talked about Section 8 in my last podcast, and I'm sure many of you all have Section 8 tenants, and it's a mixed bag, as you know. But here's here's the broad picture. And again, I know a lot of you come from different political ends of the spectrum. So I'll just give you my honest view. Okay, this is me. And again, I know some of you may not agree, and I hope you'll forgive me. The biggest problem with housing is it's not an entitlement. So under our federal government guidelines, housing is not considered an entitlement. So you basically have, while something, I can't remember the figure, but this tremendous number of people qualify for Section 8 vouchers, there isn't the funding for it. So, it's just a cluster mess right now in broad strokes because the program doesn't have enough money. The waiting list is like 10 years. There's a lot of fraud in it and everything else. But I think, I know big government makes a lot of us nervous, but the idea of Section 8, Mark, I like. It's an economic carrot. It doesn't, if they get it right and can make landlords indifferent and pay landlords a market rent. I mean, not a BS market rent based on every property in the zip code is the same rent, the way they do it now, by the way, which is, again, a mess. You know, so if you're 2-bedroom in the 900 zip code or whatever, that's the rent we're going to pay you. We don't pay you more, you know. So but if they sort of, again, did it right and expand the funding, it would, I think, go a long way to certainly shrinking the wealth inequality and making housing more affordable. But again, Mark, you know, do they have the wherewithal and the guts to make those changes? I mean, maybe you got some views on it, but I mean, I don't know much about Chicago, but LA Housing Department or LA Housing, it's a bureaucratic disaster, actually. And their budget is, I can't remember what the number is, don't quote me, but it's like 3 times what actually goes to freaking help people. I mean, this is the thing, you know, you look at the number of dollars they get from the from HUD and how much actually goes to supporting people. You know, you just roll your eyes. And for those of you who are kind of on the libertarian, this, again, you roll your eyes for that reason. Like, this is the problem with government. They just do it wrong. Anyways, Mark, I hope that makes sense. What do you think? Is that any thoughts that you have?
Thank you. No, you're hitting it spot on.
Okay, yeah. But that's beautiful about being a business school faculty member. I get to cold call people. When students ask me a question, or you're not a student, but someone asks me, I get to go, what do you think? And, you know, it's great. Undergrads, they'd melt, but MBAs, they do a good job usually.
So this has been perfect, Eric. Thank you. Thank you so much. We're gonna start closing out now, but I wanna thank both you and Alan for your expertise and time today. We're really grateful that you shared your amazing PowerPoint, which I'm grateful we're going to share with everyone. But before we do, you know, Alan, do you have any final thoughts or maybe one takeaway before I do my normal shutdown of the event? Alan?
Yes, thank you. First, Eric, thank you. You ran through those 9 million slides in record time, and it was just fantastic. And I had built you up to everyone who I talked to, how great you were, and how much information, and you just topped that. So thank you, Kathleen. Thank you, Los Angeles Consulting Group. As you know, we are just starting to build out this NextGen Nexus community. All aspects of being in a family business, family office, from real estate to mindfulness to impact. We're trying to bring everyone together, because if we're together, we can build something. So I invite all NextGens, sign up, check us out. That would be great. I invite all advisors. We're building our Trusted Family Advisor Directory. Love to include you in it so you can support NextGens. And if you're both those things, if you're NextGen and you're an advisor, you can sign up for all of it. And thank you again for joining us, and look forward to seeing you next time.
So on behalf of Eric Sussman, Alan Esrock, and our leadership committee member for NextGen Nexus, Heath Goldman, who's joined us today, we want to thank you for your time and your attention. We look forward to seeing you and following up next week. We'll send out another information email with Eric's PowerPoint, link to the video, and how you can join the membership on NextGen Nexus. Our next event is April 8th at 2 p.m. Pacific time, Branding Next Generation Family Businesses with Sasha Strauss. If you haven't seen Sasha, you've got to come. It is the most amazing thing. We had him on our launch and he was incredible. With that, I want to thank you all for attending. My name is Kathleen Tepley. Be kind to one another, and I appreciate you. Thank you all for joining us. Bye for now.